Okay, let me now show you a sensitivity analysis and how it is used and interpreted. Before you start using this analysis on your spreadsheet, make sure you have gone back and reset it to the settings that you think are the most likely to happen. That's what I have done here. For instance, the vacancies at 3% haven't changed the rents. I go down to, and the other big one is the cap rate that's used at the end of year 5. So when you sell the property, this will be the cap rate that will be used to convert the income at the end of year 5 into value when we sell it. Let's go up to the analysis section, and I'll show you what I've done. As we talked about in the last section, we talked about the internal rate of return, and then we broke it down, partitioned it between the various components: cash flow before taxes, cash benefit or obligation, and the appreciation. And what we found out by doing that is the appreciation made up 95% of the total return, and that is amazing. It's all back-end loaded. So we have to ask ourselves, what would happen if that changes any of these assumptions? So for instance, the cap rate, what happens if the cap rate changes or the occupancy changes? Those are the two likely variables that need to be examined. I've started a sensitivity analysis here, and I've calculated the internal rate of return, at a 97% occupancy. If the cap rate changes between 4% and then goes up to 6%. So I want to do the same thing, but I'll start differently. Let's look at what will be the internal rate of return if the cap rate at the end of year 5 remains at 4.78%. So let me go over there and make sure that's 4.78%. Go back up. And then the occupancy, we want to look at an 85%. So I'll go up here. So 85% means a 15% vacancy. I'm going to copy that. Go to this section. And now I'm going to look at the internal rate of return. What happened? Okay, at that, the internal rate of return is 0.0995, less than 1%. So if the cap rate stayed the same and the vacancy went to 85%, we make almost nothing on the property. Keep that in mind. Now, how about if the occupancy went to 100% with the same cap rate? Let's calculate that. The only thing you have to change is up here. So the vacancy is 0. And I am going to copy that. Now let's go back over to the internal rate of return. And the internal rate of return is 7.92%. All right. So at 100% occupancy, if the cap rate stays the same, the maximum return is 7.92%. That is definitely nothing spectacular. All right. So let's go to the best case scenario. Let's see. We have it at 100% occupancy right now. Let's change it and look at a 4% cap rate at the end of year 5. Okay, and that is the cap rate that will be used at the end of year 5 to calculate the sales price. If that's the case, the maximum internal rate of return is 13.35%. That's the highest we can achieve with this property. Okay, what happens if at an 85% occupancy? Okay, let's change that. So I'll change this to 15% vacancy. Let's go back down here. Add a 4.0 cap. Let me just make sure. Oops. Yep. Go back up. And the internal rate of return is 3.79. So if the market improves, people are willing to spend more, and the cap rate goes down, for the property, the maximum return we can achieve at 85% occupancy is 3.79%. Just keep all that in mind for a second. Now, I have it at the 85% vacancy. Let's look at what happens if the cap rate at the, again, end of year 5 is 6%. The internal rate of return, a negative 7.35%. There it is. That's a negative 7.15%. If the cap rate goes down, the market turns out to be worse than we thought, and we have an 85% occupancy, 15% vacancy, the internal rate of return is a negative 7.15. Those operating numbers are not bad. The only thing that changed was the market. Wow. One more thing. Let's look at 100% occupancy and a 6% cap rate. 100%. So we're going to change this to 0. Okay. And the internal rate of return goes to 0.73%. 0.73. So let's look at these numbers now. The absolute maximum return on this property, if the market improves and the cap rate goes to 4% at the end of year 5, the internal rate of return is 13.35. The worst case scenario is, and which doesn't sound that bad, the cap rate goes to 6%. We bought it, remember, at 4.78, but the cap rate goes to 6 and we have 85% occupancy. You will lose 7.15%. Okay, I just wanted to show you how that works, and that is what you should be considering when you're investing, is what the impact will be on the investment with these changes. And I recommend that you use cap rate and occupancy. I've seen other analysts use different numbers to compare, but those two are probably the most commonly used. So what's the best case scenario for this property? 13.35. The worst case, losing a lot of money, 7.15%. Okay, that's it. Let's just move on.